Monday morning, folks, and welcome to a brand new episode of Finmet Mondays. Mr. Sunil Kashyap is back after a 2 week hiatus. Sunil, great to have you back again on the podcast. You've come right in time where there's been a lot of action in the markets, and I think people would be interested to know what you made of the events last week. Just to recap, we had the inflation data come in. That kind of painted a very sordid picture for gold. We also had retail sales data that came in soft.
I think we've been talking in the podcast about the relationship between US dollar and gold, and the fact that the US dollar rate keeps fluctuating depending upon what the Fed is going to do with interest rates. And so last week was a perfect example of that. The market was expecting that the Fed is going to increase rates in March and again in June. We saw a very high inflation print, and that made people recalibrate. That affected the US dollar. US dollar became stronger. So obviously, US dollar becoming stronger meant gold suddenly became weaker, and we saw this swoosh down towards below 2000. The short-term moves are still being governed by the US dollar movements. I would say, having said that, physical demand for gold remains very solid. And so I think some of the rebound you saw was partly technical because it was oversold, but also because there's an underpinning of strong physical demand right now. Just from a technical point of view, so what do you see as the levels going forward?
Let's jump right into it. We are in a slightly bullish pattern, at least in the last two trading days that we saw last week. I don't think this momentum is going to be sustained. What is happening in the markets currently is that there's a very sudden resurgence in the bullish momentum, but not a similar momentum that we see whenever there's a bad news for gold. The drop in gold is not as sharp as the rise in gold. I think that's what I'm basically trying to say. And you see that reflecting as well, right? You would have expected that the inflation reading would have really dented gold's movement. The 1982 support that you see here that gold has held, it could have actually fallen to much more. But surprisingly, we found a lot of technical buying at this level, and we've been able to pull up as well. I was just looking at
Mm.
something related to the volume and open interest of COMEX gold futures, because futures kind of gives us a better perspective of how markets are shaping up. And what I see is, at least from the start of the year, from 5th of Jan to now 16th of Feb, we've been seeing that the volume has been very topsy turvy. There's not been a very consistent trend in daily volumes, but you see the open interest slightly declining in terms of trend, right? What this is telling you, the topsy turvy volumes and a steady open interest, is that there's a lot of rolling over of positions that's actually happening, and there's not a lot of people exiting or squaring off their positions, right? And that kind of tells you what the sentiment is like. People are wanting to be there, maintain the exposure in the markets from a long term perspective. No one's going away, and that also is kind of
Mm.
supporting gold prices going forward. So this was just
Mm.
something that was interesting to see as well from an open interest
Oh, I
perspective.
agree. I agree. I think just to summarize what you're saying is, I think we're range bound with a bias towards the upside.
Correct.
And especially if you have a situation where the dollar weakens, suddenly you could see gold going up a little bit. So the bias is upwards. There's a lot of support from physical, but the overall behavior is going to be range bound for now.
Correct. Just looking to next week, we have the FOMC minutes. I think people are really interested to know what went behind the scenes into the decision making from the interest rate perspective. That would be the main key event to look out for. But apart from that, we're typically going to be range bound in this 2000 to 2030 zone that we've now breached, basically. Thanks, Neil. Thank you for taking the time out and sharing your insights as well. We look forward to ensuring that our predictions come out to be as accurate as possible. But yeah, till then, thank you so much and goodbye.